Hello everyone, hope you're doing well. I'm just going to go over the practice work that I gave you yesterday and just kind of make sure that you understand what's going on. Remember, I'm not covering any new material this week because I want you to just kind of practice what we've already learned in class, and then we'll move on to new material when we return from spring break. All right, so the first entry we have here is how much cash are we raising from both the common and preferred stock issuances and sales. So when we do this, remember, whatever is the par value, that goes into the common stock account. Anything over par goes in the paid in capital excess of par. So what you want to do is always kind of focus in on the par value and then make sure that you read the problem, you understand. So for the first one here, we have a $2 par common. We're selling 20,000 shares at $15 a share. So the first thing you want to answer here is you want to answer how much cash you're raising from the sale of stock. So we have 20,000 shares, and we're going to multiply by $15 a share, and we get 300,000. So the common stock sale is going to be a total of $300,000. And then how much of that goes into the common stock account is the par value. Remember, for common stock, par value is a legal requirement. And so $2 times 20 gives you $40,000 goes into the common stock account. The remaining $260,000 is going to go into the paid in capital excess of par account, and then make sure you put a little dash there, common stock. And so what's going to happen there is the remaining amount goes there. So that's how you handle the issuance of the common stock. And now we have the issuance of the preferred stock for the problem. And so when we do that, we have to ask ourselves, how much money are we raising here? We are raising, it looks like we're selling 1,000 shares at $75 a share. I know it's 75,000. Let's just do it on the calculator here. So there we go. We got our 75,000. So that's the cash that we're receiving on the sale of our preferred. Now, what's different is that preferred stock, and we've talked about this already in class, but preferred stock has a higher par value because that's what they base the dividend off of. The common stock par value is a legal requirement. It's arbitrary, where the preferred stock actually means something because that's how the board knows how much to pay the dividend for preferred stock. So here we have 1,000 shares, and if the par value is 50, 1,000 times 50 would be 50,000 goes in the preferred stock account, and then the paid in capital excess of par preferred stock would hold your remaining 25,000. Right, so 25,000 went over the amount there, and that's the answer to number 1. All right, problem 2 is kind of stepping up the game a little bit because it wants us to do the statement of owner's equity, or the owner's equity section of the balance sheet. So when we look at the owner's equity part, we have to kind of break this up into contributed capital and then the retained earnings part. So the first one we're looking, as we read this problem, it's kind of setting the stage. Okay, you have no par common stock. And so when we look at the no par common stock, we have to realize that whatever we issue, everything is going to go into the common stock account. So as we kind of type that up, so since the common stock has no par, everything is going in there. So the total dollar amount is going to be dumped in there. So that $5 million is going to be, it's going to be grabbed and all going into that common stock account. And so now we're going to look at the preferred stock. So the preferred stock, we're just going to kind of write our little sentence here. Our preferred stock does have par on this particular one. So if we look up there, it is $100 par value. So it's got a $100 par. And then it looks like we have 750,000 shares are authorized, so 750,000 authorized shares. And then we actually have how many that are held by investors. It says here, down here, it says 50,000 shares of preferred stock. So we have 50,000 shares that have been issued and outstanding. And it has a 7% is the is what they're paying the dividend off of. So since it has $100 par, 7%, if you take 100 times 7, it would be a $7 dividend for that one. So what goes into that account then is the par. And so in this case, if I take the, what I kind of do here is I kind of have to work backwards and look at how much did I sell each share for. So what I want to do is I want to kind of calculate the difference in numbers. So as we look at our numbers, we sold the grand total of the preferred stock was 5.2 million. And since it has 50,000 shares, 50,000 shares times the $100 par gives you 5 million goes into the preferred stock account. And then the paid, and I'll just abbreviate here, I'll write it out like paid in capital excess of par for the preferred stock. That's the other amount, so that would be the other $200,000. So if we look then, we want to come up with a total contributed capital. And so that's just the total of the money that we received. And so the grand total here, it looks like it's $10,200,000. So now we have to handle the retained earnings part. And so it said no dividends were paid in this time period. And so therefore they're retaining the whole $375,000. And that's equity financing. And now we're going to have a total owner's equity. And then you just add up the contributed capital and retained earnings, and that gives you your ending number. So if I take my 10, then if I take my 10,200,000, and then I add in my retained earnings amount, my ending owner's equity would be 10.5. So 10,575,000. So that's how you would kind of interpret and fill out the equity section based off of, without having to do entries. You could kind of look at the paragraph and kind of piece that together. All right, problem 3 then. We're going to break down problem 3. Okay, so the first thing that's going on here, it's purchasing 4,000 shares of its own stock. And so when they purchase on that February 2nd, 03, when they purchase their treasury stock, it's going to go into that treasury stock account. And so the treasury stock account is going to go up. So you're going to take that 4,000. I'm going to go over to the calculator. You're going to take that 4,000 and multiply how much they're buying it back at. So 4,000 times 15 gives you $60,000. So the treasury stock account is going up, which is a contra equity account. Thereby, the overall equity is going down on that repurchase. And so you just have to remember that they repurchase it back at 15. So when they go back and resell that on the 25th, you're just going to kind of do a reversing entry, but you just got to pay attention to the amount of shares. So the amount of shares that's happening here, they're basically going to receive cash on that, and they're reselling it 2,000 times 21. So when they go out and resell those 2,000 shares at 21, they're going to be receiving $42,000. So we're going to debit that $42,000, and then we're going to reverse out that treasury stock amount. Now, the treasury stock amount happened to be, we bought it back at 15, so we got to take into account that 15 that we bought it back. So the reversing entry, we're going to take 2,000 times 15, and that goes into, it decreases the treasury stock balance by 30,000. But we're so off by 12, and that goes into paid in capital. Treasury stock, and it does that, I'll get it guys, and that does it by 12,000. Okay, so that's considered paid in capital. And then they sold 500 more shares at $14 a share. So we're gonna date it here. We're all the way in June now, and so there's our date. And then we're asking ourselves how much cash we're gonna receive. Well, it's 500 shares times 14, and we're gonna get the $7,000 of cash coming in. All right, so there's the 7,000. And then the treasury stock, we've got to remember we bought it back at 15, so that's our amount. So this one gets a little tricky because we bought it back at 15, and so now we're selling it at a price that's slightly lower. So that treasury stock is then reversed out, and remember we bought it at 15. So when we sell the 500 shares of treasury stock back out, remember, we rebought it for 15. So watch what happens. This one we really haven't talked about, but if you take the 500 shares and you multiply it by 15, what you bought it back at, it comes out to 7,500. So treasury stock will go down by 7,500, but you see on the debit, we only sold it for 7. So what we're going to do here is we're going to make an adjustment to the paid in capital treasury stock account. And we're going to lower that by $500. Okay, so let me just kind of even it out here so it looks a little bit nicer. There are my two debits, and then there's my credit. So now we balance. So you can see if we resell treasury stock at a price lower than which we bought it, we're going to reverse it back out by the same amount in treasury stock. But what we'll then do is we'll adjust the paid in capital treasury stock. All right, so last one here, we're reselling at 17 a share. So we're going to date our journal entry here. So it looks like we're at the end of the year, 12/15/03, and so we're going to take that 1,500, multiply it by $17 a share, and that's how much cash that we're going to resell back out. So I got 25.5. So there's the 25.5. And then we got to remember that $15 amount, so that's the reversing entry on treasury stock. So we're going to take the $15 that we bought it back at, multiply it by the 1,500 shares. We get 22.5. And then that dollar difference is going to go back in the paid in capital. So that paid in capital kind of balances out that reselling of treasury stock. If you resell the treasury stock for more than what you rebought it at, the paid in capital treasury stock account will be credited. If you sell for less than what you bought it back, we debit and we decrease that paid in capital treasury stock account. So in this problem, we are selling it for more. So there's the 25.5, and then we're going to take out the 22.5. And we get 3,000 there. I didn't need to use a calculator, but I just wanted to show you how that was done. Right? All right. Okay, so that's your problems. Just kind of look those over and make sure that you understand them. Thank you.